Good afternoon, everyone. How are you all? Okay, fantastic. Yes. So, my dear friends, we will continue our journey from where we ended last day. We are in theory of cost part 2, and this, in fact, as far as cost is concerned, is also our last class on the same. Okay. Now, while we discuss long run average cost curves, please remember the short run average cost curves are also called as plant curves. Plant curves. PLANT. Short run average cost curves are also called plant curves, while long run average cost curves are. We had discussed short run average cost curve yesterday, right? Yesterday means the last class, okay? Now we are discussing long run average cost curves. When I talk to you about long run average cost curves, they have two different names. Yes, they are also U-shaped, not because of the same reason, but yes, they are also U-shaped. But they are also called long run average cost curves are also called. Please remember, they are called by two names. Number one is blanket curve. And the other one would be envelope curve. So there is this blanket curve and then there is this envelope curve. Now, sir, why is LAC curve? Why is LAC curve also called as blanket curve or envelope curve? You see, can you see the LAC curve here? Yes, sir, we definitely can. Now, my dear friends, the LAC curve that you see here is composed of multiple SAC curves, as I am sure you are able to see, like this one, and then you get onto this one, again you move on to this one. So when you're constantly seeing a lot many SAC curves here, when from their minimum points, you are passing a line that is basically forming you or giving you a LAC curve. So what exactly is LAC curve? My dear friends, LAC curve is basically a curve containing multiple SAC curves. And since it's passing through their minimum points, we also call it envelope or a blanket curve. Mind you, SAC curve is also called as plant curve. PLANT, plant curve. Okay. And remember, from where does LAC pass? From the minimum point of multiple SAC curves. As you can see, for each SAC curve, there is a minimum point that has been shown to you in the given diagram, right? So if from each minimum point, if you join them out, you will get another U-shaped curve called LAC curve. Now, friends, coming back to the last class, we had discussed the multiple reasons, like, for example, be it marginal cost curve, be it average variable cost curve, and be it, let's say, average cost curve for that matter. In all the respective three cases, what had we discussed? We had discussed that the respective curve was what we had discussed. We had discussed that the respective curve was U-shaped because of law of variable proportion. Why? Because of law of variable proportion. They were U-shaped because of law of variable proportion. Right? Yes. Absolutely right. No. But when we talk about long run average cost curve, yes. If you talk about LAC curve, absolutely your answer would be again U-shaped. But remember, you are in the long run here. So there is nothing called variable and fixed cost, number one. So only average cost we discussed, long run average cost. But why is it U-shaped? My dear friends, the logic is the law that operates in the long run. Do you remember what law operates in the long run? Yes, sir, we definitely do. It's the returns to scale. And hence our answer here would be returns to scale. Absolutely correct. And our answer here would be returns to scale. You are absolutely correct in saying so. Acha, is that so, sir? Yes, my dear friends, that is so. So here you have it, LAC curve U-shaped due to returns to scale. Absolutely, sir. Fantastic. Sir, with that being said, what next? The question is, what next? First of all, if they ask you why, then you will answer due to returns to scale. U-shape because of returns to scale. Now, what is this returns to scale? Actually, when you produce on a large scale, there are certain advantages that arise to a business firm. I will explain each one, don't worry. But those advantages that happen due to large scale production in the long run, is called economies of scale. But beyond a certain optimum level, if you keep going on, then instead of advantages, you start facing disadvantages or you start suffering disadvantages. Such disadvantages are called diseconomies of scale. So advantage of scale basically refers to the advantages that arise because of economies of large scale production, in the long run, obviously. But the disadvantages that arise when you cross that optimum boundary, that disadvantage is called diseconomies of scale. Okay. But for understanding purpose, let me give you an example of economies of scale first. Okay, you will understand it pretty well, I am sure. Suppose, guys, I've taken this factory on rent. Okay, now this factory has a production capacity of, let's say, around 10,000 units. Okay, now the rent of this factory is rupees 40,000 per annum. The rent of this factory is rupees 40,000 per annum. The capacity is 10,000 units. Okay, but due to low market demand, let's say you are producing only, let's say, 100 units maybe. Let's say you are producing only 100 units. So if you are producing only 100 units, can you tell me what the per unit cost is? The per unit cost would somewhat be, you see, 40,000 divided by 100. So it is rupees 400. Why is it rupees 400? Because you are producing only 100 units. Now let me take you to a world where you are indeed producing 10,000 units entirely. Since you have that capacity, mind you, now the same thing, when you turn it up and you turn the production up to, let's say, 10,000 units, the cost has gone down to rupees 4 per unit. So this fall in per unit cost, the fall in per unit cost of production because of large scale production is called economies of scale. This is the advantage I was talking to you about. That is, when you operate on a big scale, when you produce large quantities, there are certain benefits that arise, like fall in cost per unit. The fall in cost of production per unit is called economies of scale. This advantage is called economies of scale. You remember in the last few classes, I had told you one example. I'm not sure whether you remember it or not. I told you that a 1 liter bottle of Coca-Cola takes only about 60 paisa to manufacture. Why, sir? Because Coca-Cola is producing in such a massive scale. Around 190 countries it is catering to. Since it's catering to around 190 countries, my dear friends, obviously there are certain advantages that will accrue in the process. Like fall in cost of production per unit. And hence, my dear friends, that is what we call as economies of scale. Is it crystal clear, friends? Yes or no, please? Okay. Yes. Yes. Sir, we definitely did understand. So this is what economies of scale is all about. This is what economies of scale is all about. Now moving on. Diseconomies or disadvantages. See, you must study economies. Diseconomies arise when you go beyond your limit. So the simple trick is, whenever you are exceeding your limit, that is diseconomy. That is very simple to remember. Your entire learning should be around economies of scale. Okay, sir. That is what economies of scale is about. Now, as I told, economies of scale is referring to the advantages that you take, that you have. Economies of scale is referring to the advantages that you enjoy. Yes, sir, we certainly do. Now, since economies of scale is referring to the advantages that you enjoy, please remember, these advantages can be both internal in nature or external in nature. Internal means those advantages which are restricted to that business firm or an individual business organization. These are restricted to that only. That, my dear friends, is called internal economy. Okay. But now, there are certain advantages that occur in the industry because of which each business is able to take advantage. Okay. That is external economy. Again, just like economies, there is internal and external diseconomies. I will tell you one thing. Internal and external diseconomy, don't try to learn. Because if you have understood, please pay attention. If you understood internal and external economy, Automatically, internal, external, diseconomy you have understood. Like it is logical. That is, diseconomies is whenever you go beyond the limit. Thus, that's it. Okay. So now let me explain you. Let me explain you further. What are these internal economies advantages and diseconomies disadvantages? Remember, I will only explain economy part. Diseconomy is you automatically understand that it has gone beyond the limit. I have repeated it multiple times. I know this, but that is what the truth is ultimately. Now see, now see, now see. Let's go ahead and discuss one of them, each one of them. Okay. See. First of all, technical economy. What is technical economy? Remember, we are discussing the internal part. So now don't come and ask about the external advantages. See, technical. Now, my dear friends, if you are deciding, remember, this advantages will only arise if you produce on a large scale. Okay. Now let me come back to the point. Now, my dear friends, suppose there are two machinery. The cost of one machinery is, let's say, 1 lakh rupees, and the cost of one machinery is, other machineries, 1 crore rupees, 100 times. Now, my dear friends, suppose a business organization has decided that it will produce only 5,000, 10,000 units. So, for only 5,000, 10,000 units, what do you suggest this business organization? To buy the machine that costs 1 crore or to buy the one that costs, 1 lakh? What will you advise? So, obviously, we will advise to buy a lower cost machine because you're only producing 5,000, 10,000 units. Now, suppose it is a giant organization like Lay's, PepsiCo, okay? Or let's say there is a giant organization like Coca-Cola Inc. Now, they are going to produce about 100 crore units. Will you ask them to produce on a lesser sophisticated machine or a much more advanced machine? Obviously, on a much more advanced machine. This is what I'm saying. That when you produce on a large scale, on a very large scale, you are able to take advantage of the latest technology, which you won't do if you are producing on a very small scale. Technical economy, advantage, ability to use latest technology, because you can afford to use now, because your planning is to produce on a large scale. Nobody will invest huge sum if they are producing on a small scale. And therefore, this is number one economy. Technical economy, as we call it. Technical economy, you call it. Yes, sir, we understood. Understood, sir. Suppose, for example, people who are in the business of, let's say, movie, TV shows, they have this specialized DSLR cameras. But for people like you and me, common people like you and me, do we carry DSLR camera everywhere? Generally not, sir. The reason is that we don't want to spend so much because we have not so much utility of the same. And so we are not, because we will not be using it on a larger scale. So we are not using the latest technology available. That is internal economy. And if you are not using, it is diseconomy. If you are unable to use, it is diseconomy. Okay. So ability to use the, you have told us, sir, ability to use the latest technology. Right, sir? Did we hear it right, sir? Absolutely. Due to which specialization of labor, division of labor is also possible. That is also technical economy. Got it, sir? Got it, sir? Now, my dear friends, let's move on to managerial economies. Okay, let's talk about managerial. Remember, all these are internal in nature. All these are internal in nature. Okay, now see. Suppose, my dear friends, there is this small business. I'll write it down here. Small business, and then there is big business. Now, you will tell me, if I want to make different departments, if I want to hire different specialists, let's say there will be a marketing guy, there will be a finance person, okay, there will be a marketing person, there will be a finance person, there will be accounting head. A big organization is in the potential to divide this. There will be a, let's say, IT head, IT department head. A big firm is able to bring in this specialization, hire specialists. But in a small organization, as you can see, whenever you will also start your business, only you will be the marketer of your business. Okay, only you will be the accountant of your business. Only you will be the finance guy of your business. So everything will be performed by one person or two person maybe. So therefore, organization that will produce on a massive scale will be able to take advantage of what? Of specialized people who are the experts of that area. And that is, my dear friends, called managerial economy. Because you have taken the decision to produce on a large scale. Remember, economies of scale is an advantage that will operate only when you're deciding to produce on a large scale. So let's say if your idea is to produce on a smaller scale, obviously you will not be able to enjoy any advantage. Yes, sir, we got it. That is managerial economy. Sir, we understood this. Now moving on to, acha, my dear friends, please remember. First of all, I'll explain these entire points in English only. Then I will summarize them in Hindi also. But first, listen carefully. So this is technical. There was this managerial economy. Now let's talk about financial economy. See, a business operating on a large scale will require large funds. And since they are taking large funds from the bank will generally give them these funds at a rate of interest which is very less. Bank will give them this loan at a rate of interest which is very less. Why is it so, sir? It is so because the rate of interest is very less. See, remember, it is able to gather large funds because the rate of interest is very less. Why? Because it is taking on a huge amount from the bank. So bank doesn't mind earning small rate of interest also on such a huge sum. Okay, sir, it is perfectly logical. It sounds perfectly logical to us. Fantastic. Now, risk-bearing appetite. Obviously, my dear friends, you will see that organizations that operate on a large scale is in a better potential to bear risk, to take risk, compared to a small scale organization. And that is the risk-bearing advantage. And finally, commercial economy. That is yet another good point. Another good point, that is commercial economy. Sir, can you tell us what it is, commercial economy? You see, my dear friends, every organization for production requires raw material. Now, suppose, let me ask you a question. You will tell me what commercial economy is. Suppose there are two companies or two brands. Let's say Lace is on one side and number one is some XYZ brand. Okay. Now, both of them are in the business of producing chips. XYZ's raw material is also potato. Lace raw material is also potato. Who will be able to buy potato? I am giving you three options. Number one, Lace will be able to buy potato at a lower cost. Number two, XYZ will be able to buy potatoes at a lower cost. Or option three, both will have to buy the potatoes at the same cost. What do you think will be the correct answer? Come on, tell me. Both are in the same business of chips. You all tell me the answer, please. Absolutely. When you people have, given me the answer, it's absolutely correct. That, sir, obviously Lace will be able to buy the potatoes at a much lower cost. You have answered this. Why? Because Lace is going to purchase from the farmers directly on a large scale. And so they will be able to buy this raw material at a lower cost. This is called commercial economy. That when you operate on a large scale, you are able to buy raw materials at a much lower cost compared to your competition. Oh, we got it, sir. So raw material at very, very low cost. Raw material at very, very low cost. Absolutely. This advantage is called commercial economy. This advantage that Lace enjoyed is called commercial economy. So, my dear friends, this was the internal points explained. Now, I will explain this entire thing or revise this entire thing in Hindi once again. See, दोस्तों, जब आप प्रोडक्शन को लार्ज स्केल में करते हो, जब आप जो आउटपुट बना रहे हो, अगर आप उसे लार्ज स्केल में बना रहे हो ना, आपके पास कुछ एडवांटेजेस आएंगे. उन एडवांटेजेस को आप इकोनॉमीज बोलते हैं. एंड अगर आपके पास कुछ डिसएडवांटेजेस होती है, उन्हें आप डिस इकोनॉमीज बोलते हैं. ठीक है ना. एडवांटेजेस आपके ऑर्गेनाइजेशन के अंदर भी रह सकते हैं या आपके ऑर्गेनाइजेशन के बाहर भी रह सकते हैं. अगर अंदर है तो इंटरनल इकोनॉमीज, बाहर है तो एक्सटर्नल इकोनॉमी. ये बात याद रखिएगा कि ये एडवांटेजेस तभी होंगे आपके पास, या ये फायदे, एडवांटेजेस मतलब फायदे, ये फायदे आप तभी इंजॉय कर पाएंगे जब आप ज्यादा क्वांटिटी में, ज्यादा मात्रा में प्रोडक्शन कर रहे हैं, ठीक है। टेक्निकल इकोनॉमी का अर्थ है कि देखिए, जब आप ज्यादा क्वांटिटी में प्रोडक्शन करेंगे तो आपके लिए पॉसिबल है, अगर आप ज्यादा क्वांटिटी में प्रोडक्शन करेंगे तो आपके लिए ये पॉसिबल है कि आप लेटेस्ट टेक्नोलॉजी, आधुनिक टेक्नोलॉजी का आप इस्तेमाल कर सके, है ना। दैट एडवांटेज इज कॉल्ड, इस एडवांटेज को टेक्निकल इकोनॉमी बोलते हैं। एक छोटा बिजनेस नई लेटेस्ट टेक्नोलॉजी यूज नहीं करना चाहे। दूसरी बात, मैनेजरियल इकोनॉमी। अगर आपका बिजनेस लार्ज स्केल पर ऑपरेट करने लग रहा है तो ऑब्वियस सी बात, आप क्वालिफाइड लोगों को हायर कर सकेंगे, हर जगह के स्पेशलिस्ट को आप एक काम दे देंगे कि भैया तुम मार्केटिंग संभालो, तुम फाइनेंस। इसको बोलते हैं मैनेजरियल इकोनॉमी, फाइनेंशियल इकोनॉमी। अगर आप लंबे पैसे उठा रहे हैं, ज्यादा पैसे उठा रहे हैं क्योंकि आप बिजनेस लार्ज स्केल में कर रहे हैं, तो आप एक आम इंसान के मुकाबले आपको जो रेट ऑफ इंटरेस्ट पे करना पड़ेगा वो कंपैरेटिवली कम होगा। इसे हम कहते हैं फाइनेंशियल इकोनॉमी। नेक्स्ट है रिस्क बियरिंग इकोनॉमी। सीधी सी बात है ना, अगर आप एक बड़े स्केल पे ऑपरेट कर रहे हो तो आपके पास जिगरा ज्यादा है, आपके पास ज्यादा डर झेलने का क्षमता है, बिकॉज आप बड़े यूनिट्स पर ऑपरेट कर रहे हो। इसको बोलते हैं रिस्क बियरिंग इकोनॉमी। और आखिरी बात है कॉमर्शियल इकोनॉमी। अब देखिए, जो रॉ मटेरियल यूज होता है, अगर आप चिप्स बना रहे हो तो आप आलू इस्तेमाल करोगे, आलू एक रॉ मटेरियल है। अब क्योंकि आलू एक रॉ मटेरियल है, जरा ध्यान दीजिएगा आप लोग, तो इस आलू को इस्तेमाल करके आप ज्यादा क्वांटिटी में मैन्युफैक्चर कर पाओगे। तो ये जो रॉ मटेरियल आप सस्ते में खरीद पाओगे क्योंकि आप लार्ज क्वांटिटी में ऑपरेट कर रहे हो, इसे हम लोग कमर्शियल इकोनॉमी का नाम देते हैं। किसका नाम देते हैं सर? कमर्शियल इकोनॉमी का नाम देते हैं। मुझे उम्मीद है आपको बात समझ में आ गई होगी। यस सर, इट्स क्रिस्टल क्लियर टू अस। Now let's move on. Let's move on to the external economies and diseconomies. External economies and diseconomies. Right, sir? Now see, external economies and diseconomies. Why is it, sir? Sir, this number one is cheaper raw material and capital. Now you will ask me, sir, the raw material point you explained before. So now let me answer this. Let me answer this, my dear friends. See, what happens is cheaper raw material and capital. See, in your industry, there are multiple businesses. So if everybody is demanding the same raw material, in general, the price of raw material in that market will fall. Yes, that is called external economy. That means that not only because your business wanted this product more, other businesses also purchase this product more. As a result, since everybody purchased this product more, the overall price of this raw material fell down in the market. And that's what the first point is all about. Number two, technological economy. Now, what happens is, my dear friends, technological economy means when you operate on a large scale. See, when you operate on a large scale, what happens? What happens when you operate on a large scale? See, when you operate on a large scale, the technology which was not originally there, now new technology is discovered. So new discovery starts taking place, and therefore disadvantage arises. Because suppose an industry is very small, then nobody will create new technology for that industry. Only when industry is big, then people will be willing to create new technology for that industry. Suppose you see a show like Shark Tank. In Shark Tank, you will always see that people who have a scalable business, they bring in new technology, or their business is where the sharks prefer to invest because they have massive scaling possibility at least. Understood, sir? And that advantage is called technological economy. Understood, sir? Yes, sir, we did understand. Next is skilled labor. Obviously, my dear friends, if an industry is doing well, okay, if an industry is doing well, if an industry is growing, pay attention. If an industry is doing well, if an industry is growing, then people will start, the laborers will start taking training because they want to work in such industries. And this will make skilled people. And when skilled people work in your organization, obviously production takes on place on a large scale. And another advantage in that manner. Again, ancillary industries, very important, very good. Suppose, my dear friends, a lot of car companies are being set up. Now, what are these ancillary industry? Ancillary means supporting industry. What does it mean? It is supporting industry. So what they will do is, They will not start a car company. What they will do is they will start manufacturing nuts and bolts which are required for tires. They will start manufacturing paints which are required to paint cars. So what is happening? That whenever a business operation grows, ancillary businesses start coming up. When ancillary businesses start production, they are able to sell these nuts and bolts at a very low cost. And therefore, this point. And therefore, this point. Finally, information. Finally, my dear friends, is information. See, information is basically about latest updates. Since latest updates are available to businesses, like suppose a latest update is, let's say demand for petrol will rise. Now companies dealing with petrol, they may start acting accordingly. Or the companies producing electric vehicles will start thinking that, oh my god, petrol's price will increase, so let's start production of electrical vehicles once again. Because my prediction is, my dear friends, in the upcoming future, everybody who is in the business of EV, electronic vehicle, will make profits. It's my estimate. Why? Because the industry is going towards EV and the electric vehicles, and so information plays a crucial role. So when this information circulated in the market that government is preferring EVs now, automatically there will be businesses who will start, like you can see the Tatas and Mahindra Group. They have already taken initiative to make electronic EVs, electronic vehicles, electric vehicles. Why did they do so? Because they got the information. That is another advantage. I hope it's crystal clear. Sir, now let me summarize it in Hindi also so that everybody is on the same page. Okay? Let me summarize this entire thing in Hindi as well. See, देखिए पहला पॉइंट क्या है? अगर रॉ मटेरियल सस्ते में अवेलेबल है, तो ऐसा क्यों है? क्योंकि इंडस्ट्री में सबको रॉ मटेरियल चाहिए, तो रॉ मटेरियल का प्राइस अपने आप ही घटते चला जाएगा. दूसरी बात, जब इकोनॉमी में बिजनेसेस बड़े होते हैं तो नई टेक्नोलॉजी बनने लगती है, ये दूसरा एडवांटेज. तीसरा, जब एक इकोनॉमी में इंडस्ट्रीज और बिजनेसेस बढ़ रहे होते हैं तो लेबर भी स्किल्ड हो रहा होता है. चौथी बात, जब एक बिजनेस बड़ा हो रहा होता है तो उसको सपोर्ट करने के लिए कुछ छोटे छोटे बिजनेस पैदा होने लगते हैं. जैसे अगर एक गाड़ी की कंपनी है जिसको नट्स एंड बोल्ट्स चाहिए, तो एक नट्स एंड बोल्ट की कंपनी भी सेटअप हो गई. और फाइनली, जब आपके पास इंफॉर्मेशन हो तो आप टाइम से पहले एक्ट कर पाओगे, जो आपके लिए एडवांटेजियस होगा, सर बात तो देखो क्रिस्टल क्लियर है. Is that clear, friends? Yes or no, please? Why don't you answer these questions to me, friends? Are you ready, friends? Are you ready to answer some questions to me? Okay, sir, let's go. Let's see. What is the shape of average fixed cost? It remains same at all levels of output. It increases as output increases. Average fixed cost decreases as output increases, or initially increases then decreases. What say, friends? Which one do you think is correct? Come on, everybody. Very good. So, see, average fixed cost is absolutely total fixed cost divided by quantity. So, as total fixed cost will remain same, and quantity is going to constantly rise, therefore, AFC is going to constantly fall, and hence your answer that AFC decreases as output increases. Absolutely. AFC decreases as output increases. Right. All the curves except dash are U-shaped curves. Can you answer me this? Is it the MC curve? No. Is it the AD curve? No. Is it the AC curve? No. It's this rectangular hyperbola curve. AFC curve. AFC curve is the answer. Now moving on. Normal profits earned by a firm. Very interesting and easy question. Are included in what? Yes, absolutely. Normal profits form a part of implicit costs. Absolutely. Normal profits form a part of implicit costs. Got it. Next, my dear friends, the question was, this too I have already discussed, that accept average fixed cost. So no need to answer. Yes, this is a good one. Let's hear it from you all. Okay, so there are these three people, Nishant, Tavleen and Manas. They are confused with the formula for deriving total cost. Like, what will be the formula for total cost? No, Nishant is saying it will be TFC plus TVC. Tavleen is saying no, it will be AC in output, AC into output. Manas says no, it is sum total of marginal cost plus total fixed cost. Identify who amongst them is correct. A, is it Nishant? Is it B, Manas? Is it C, Tavleen? Or is it all of them? What do you think, my dear friends, is the correct answer? What do you think, my dear friends, is the correct answer? Absolutely. So all of you are saying C, D, all of them. Not C, it will be D. You know why? Because yes, total cost is TVC plus TFC, correct? Now similarly, if you have to find average cost is total cost divided by quantity produced. So Baba, what is total cost equal to? Total cost is equals to average cost into quantity, na re Baba? Oh, ha, sir, yes. So this is also correct. Now, what is sum total of marginal cost? It is nothing but total variable cost. Yes or no, sir? Yes, my dear friends. And therefore, this is the answer. Correct. MC curves intersect AC curve at a dash point and AVC curve at a dash point. Obviously, minimum, for both minimum. You all remember this curve, na? This is AVC curve. This is AC curve. And here it has struck from the minimum point. So minimum is your answer. So your answer will be minimum. Acha, is that so, sir? Yes, that is so. I'm sure all of you have understood this. Next, moving on to the next, let's say a numerical type question, whether you friends are able to answer or not, let's find it out. A firm has a variable cost of 1000 at 5 units of output. If fixed costs are 400, what will be the average total cost at 5 units of output? Can you answer this question, please? Come on, friends. Average total cost as 5 units of output. Come on, let me hear it out. All right. So, sir, if you have understood this, now pay attention, my dear friends. Variable cost 1000 and fixed cost 400. So total it becomes 1400. Now, for how many units? Now, my dear friends, it's for 5 units of output. So 1400 divided by 5. It gives you what? It gives you 280. So what will be the average total cost? It will be 280. What will be the average total cost? It will be 280, because you see, they've asked total, average total. So 1400 divided by 5 will be the correct answer, right? Absolutely. Okay. Sir. Now, identify this curve. Can you identify this curve for me, friends? Come on. Absolutely. Sir, this is a rectangular hyperbola. You are absolutely correct. This shape is nothing but a rectangular hyperbola. And since this curve is a rectangular hyperbola, we will answer our question to be average fixed cost. This is our answer. AFC curve is a rectangular hyperbola. Yes. Now moving on. Now, my dear friends, one of our friends has asked, last day we discussed stair-step variable cost. So one of you friends have asked me to explain stair-step variable cost again. So let me help you out with the same. I will revise that again. Okay, then we will move to some more MCQs. Okay, pay attention, please. See, first of all, how does the graph look like for a stair-step variable cost? It looks something like this. It looks like a stairs. In your building there must be stairs. It looks like this. Building or school maybe. There are these stairs. It looks somewhat like this. It looks somewhat like this. This is stair-step variable cost. Now what is happening here exactly is, suppose my dear friends, okay? Suppose my dear friends, a factory has 3 rooms, okay? Depending upon how many units you have to decide how many rooms you need. Each room can store 1000 units. So if there are units between 0 to 1000, you will need how many rooms? 1 room. Now the rent of 1 room is rupees 5000. But my dear friends, let's see, now you need 1200 units to be stored. So as soon as you enter the 1001st unit, now whatever quantity you store till 2000, be it 1500, 1600, it is constant. Your total cost is going to be 10,000 for 2 rooms. So see, it is varying with each output level, but within a particular level, it is constant. So 0 से 1000 के बीच में constant है. Within 0 to 1000, it's constant. But as you move on to the next stage, beyond 1000, it is again increasing. Again, from 1100 to 2000, the cost is becoming constant. Again, between 1100 to 2000 or 2001 to 2000, the cost is becoming constant. Right, sir? And similarly, if you go ahead and, discuss this further, it will become 15,000 that way, right? That, my dear friends, is stair-step variable cost. Stair-step variable cost. That, my dear friends, is stair-step variable cost. I'm sure all of you have agreed. Okay. Great. So, sir, since you have agreed with this part, this portion of things, now let's solve more MCQs and let's try to gain more expertise into the topic. But before that, I will like to summarize this entire topic that we have discussed today. Okay. First of all, we discussed about returns to scale. In what time period does this occur? Obviously, in the long-term period, it occurs. In this long-term period, what is the shape of LAC curve called? It's again U-shape. But is it because of law of variable proportion? No. It's because of law of returns to scale. Remember, if the costs are falling, please remember, if you see declining costs, this is because of economies of scale. This decline in cost is caused by economies of scale. But if the costs are rising further, these are called by, crossing the boundaries, and hence you call it this economies of scale, right? And hence the U shape. Then we studied that LAC curve is also called blanket curve or envelope curve. LAC curve is also called blanket curve or envelope curve. SAC curve is also called plant curve. Okay, remember LAC is U-shaped. Again, we discussed the advantages and disadvantages. So the advantages that accrue to the firms, in the long run, are called economies of scale, while the disadvantages that accrue to them in the long run is called diseconomies of scale. Remember, diseconomies is always operating when you exceed the optimum level. Only when you exceed the optimum level. Okay, sir? Now, as I have already pointed you out, economies is divided into 2 parts, internal and external. Internal is the internal advantages that a business firm experiences. External is that every business firm advantages that every business firm enjoys. Internal is the advantages that an individual business firm enjoys, while external is the one that every business firm enjoys. Why is it so? Because it is taking place due to some changes in the surrounding. Right. Now moving on. If we talk about diseconomies of scale, then there are this internal and external diseconomies. Internal diseconomies are basically losses, and external diseconomies are basically, again, losses due to external reasons. Internal is due to internal reasons. That is it. Then we discussed some of them. In internal economy, technical point we discussed, which implies the ability to use latest technology, division of labor. Then in managerial, the ability to hire experts when you are operating on a large scale. Remember, this economies of scale will only take place when you are operating on a large scale. Yes. Financial economy, large funds required, and so rate of interest you can enjoy is lesser than the market rate of interest. Okay, risk bearing capability high, and commercial economies implies ability to purchase raw material at a lower cost compared to competition. Why? Because we are operating on a larger scale, so our suppliers are ready to sell us at a smaller cost per unit. At a smaller cost per unit, they are ready to sell us. Moving on. External economies and diseconomies of scale. Again, everybody in the industry is going to buy cheaper raw materials. So raw materials will become further cheap because the demand is plenty now. Technology, the ability to develop new technology, skilled labor, because now labor knows that there is huge demand in this industry because this industry produces on a large scale. Then there is this ancillary industry also called supporting industry. And finally, advantages that arise due to information exchange. All right. All this is crystal clear, sir. This is what basically we are doing. Understood? Now let's move on to our dear institute's material and let's solve some of the questions. Let's see whether we are able to solve it or not. Okay. So here it is. Everybody, initially, I was not doing cost chapters, you remember, because we were not done with cost. Now the fact that we are done with cost, we will pick and choose the cost questions. Okay. Let's go about it. Right. Which cost continuously increases with increase in production? Question number 17, a good one. Question 17. Okay, one very good question has come. One very good question has come. After this, I will answer that good question. So my dear friends, which cost increases with increase in production? So obviously it is the variable cost as it changes with the output level. It's the variable cost that changes with the output level. Now a very good question I have got. I will answer this question. The question is, sir, what is normal profit? What is normal profit? Let me explain this to you in a very simple language. Okay, for this you will have to pay attention. Okay, see, I told you in economics, total cost is equals to explicit cost plus implicit cost. I told you last day. What is explicit cost? We also call it economic cost, by the way. Economic cost. It is explicit cost, that is the cost resulting in actual outflow. Implicit cost is the cost that doesn't result in actual outflow. So let's say our economic cost is in total 10,000 rupees. Okay. Now you have sold some product. Now you have sold some product and the revenue you have generated is 10,000 rupees. So my dear friends, when total cost is equals to total revenue, when total cost is equals to total revenue, please pay attention. When total cost is equals to total revenue, that, my dear friends, is called a situation of normal profit. Sir, it is also called break even, right? Yes, that is also called break even. Remember, here total cost is not just explicit cost. Because if you talk about accounts, in accounts you will study total cost is just explicit part. But economics tells us no. Implicit cost also add. Then you come to economic cost. So the scenario where your economic cost and revenue generated are both equal is a situation where you are making normal profits. Where you are making, yes, normal profits. Where you are making what? Normal profits. That's right, friends. I hope it's crystal clear, friends, isn't it? Some of you asked what is normal profit, so I've explained that. Understood now? Okay. But suppose your total cost was 10,000 and your total revenue was 15,000. So you have recovered the total cost, explicit plus implicit, and above that you were able to generate 5,000 extra. This, my dear friends, in economics, is called supernormal profits. supernormal profits. Supernormal profit. Acha. This is what supernormal profit is. Okay, sir. Very good, very good. So now let's move on to the next one. Let's see what we are able to answer here. Which of the following cost curve is never U-shaped? We have done a similar question. Almost the same question we have discussed already. Which is never U-shaped? Absolutely. AFC curve, because it takes the shape of a rectangular hyperbola. AFC curve takes the shape of a rectangular hyperbola. AFC curve takes the shape of a rectangular hyperbola. ठीक है ना? Okay, sir. Okay, sir. Okay, sir. Total cost in the short run is classified into fixed cost and variable cost, right? Total cost in the short run is classified into fixed cost and variable cost, right, sir? Yes, sir, right. Total cost in short run is classified into fixed and variable cost. Absolutely. Which one of the following is a variable cost? Acha, they are talking about raw variable cost. Is it equipment? Is it rent on building? Is it interest or is it raw material cost? Obviously, sir, it's the cost of raw materials that is variable in nature. Because more the chips, more the potatoes you need. Equipment you will not buy another. Just because you have produced 100 chips doesn't mean you will buy 100 machines. It won't change up to a certain level. Absolutely. And therefore, cost of raw materials is going to be our variable cost. Okay, sir. Then the question rises is, in short run, when the output of a firm increases, its average fixed cost will, yes, it decreases. Because as I have already told you this logic, that suppose total fixed cost is 100 rupees. Now quantity can be 1, quantity can be 2, quantity can be 3. Now pay attention here. If you see average fixed cost at level 1, it will be 100 by 100. Average fixed cost at level 2 is 100 by 2, that's 50. Average fixed cost at level 3 is 100 by 3, that's 33.3, right? And hence, you can see your AFC curve constantly falling down. You have got your answer, I believe. Yes, sir, we have got our answer. Next, good question. Which of the following is known as a planning curve? Which one of them is known as a planning curve? Which one of them is known as a planning curve? Planning curve, planning curve, planning curve. Planning curve. Yes, long run average cost. Remember, I told short run average cost curve is planned curve. Planned curve. All right. But long run average cost curve is a planning curve. So please remember, these are two separate things. Do not try to jumble them up. Do not try to jumble them up. Okay. Yes, sir. If a firm moves from 1.2 on a production isocont, it is from production, we will do that, but later on, first let's focus on cost related concepts. Which one of the following is the concept of marginal cost closely related to? Simply speaking, which one of them is used to calculate marginal cost? Which one of the following is used to compute marginal cost? Can you tell that? Yes, absolutely. The answer will be, sir, you told us that it is the difference of variable cost that gives us marginal cost, and hence your answer would be variable cost. Okay. And one more thing. Next question is, which of the following statement is correct? When the average cost is rising, MC must also be rising. Okay. When AC is rising, MC must be falling. When AC is rising, MC is above AC. Okay. And finally, when AC is falling, MC must be rising. Which one of the following do you think is correct? Take your time. It's not the easy one, not the easiest question. Come on. Slightly tricky. Easy but slightly tricky. Okay, sir. Got it, sir. So after this, we are going to move on to our next one. Which of the following is considered as an explicit cost, right? So when we move on to this one, guys, when we talk about explicit cost, we are talking about the outflows, right? When we are talking about explicit cost, we are talking about the outflows, right? So when we are talking about the outflows, friends, we are referring to explicit cost. Now, if you have a look carefully here, the wages of proprietor, the wages a proprietor could have made by working as an employee of a large firm. Remember, explicit must result in actual cash outflow. Explicit must result in actual cash outflow, right? So the wages a proprietor could have made by working as an employee of a firm. Okay, next, the income that could have been earned in alternative uses by the resource owned by the firm, the payment of wages by a firm, or finally the normal profit earned by the firm. Come on, guys, tell me which one do you think is the answer? Absolutely. Wow. Very good. Sir, explicit cost must result in actual outflows. Explicit cost must result in actual outflows. Hence, your arrival at the answer that it would be payment of wages by the firm is absolutely correct. Is absolutely correct. Payment of wages by the firm. Yes, sir, we definitely got it. So this is the one. All right. Now moving on. Which one of the following is an example of implicit cost is what they're asking. Okay. Which one of the following is an example of implicit cost? Now, if you talk about implicit cost, see, implicit cost is a cost which doesn't result in actual outflow. It's basically the money was supposed to come in, but since we are using the resource for our own business, we are sacrificing the income that we could have earned on that particular own resource, right? For example, interest that could have been earned on retained earnings to finance expansion. The payment of rent by a firm for the building in which it is housed. 26. The interest for borrowed funds. And finally, we have the payment of wages by the firm. See, it is explicit cost. It is explicit cost. Forget about this two. Can't be the answer. Payment of rents in which build it is there. So you are actually paying rent. It is again explicit cost. But the money that you had, which you are using for financing, if you would not have spent it for financing, you could have used it and generated interest on that. You could have generated interest on that in that process. In that process, that is, my dear friends, implicit cost. That, my dear friends, is implicit cost. Okay, yes, sir, we got it, sir. We got it. Moving on. Let's move on here. Let's move on. Let's move on to the next one and see what is going on. Use the above data to answer the question. You following data to answer the given questions. Okay. So you're operating from 0 to 6th level. You're operating from 0 to 6th level. Absolutely, sir. Now, total cost here is 240, 330, 410, 480, 540, 610, 690. All right. Now what they're asking is, what is the average fixed cost? What is the average fixed cost of 2 units of output? Now you see, my dear friends, when they're telling us average fixed cost at 2 units of output, first we need to know that average fixed cost is nothing but total fixed cost by quantity. So what is total fixed cost? It is 240. What is total fixed cost? It's 240 divided by what is the quantity? We are referring to 2 units here, because come on, total fixed cost is going to be the same at all quantity levels. So when you do 240 by 2, right, your answer comes to 120, and hence the answer would be average fixed cost is 120. Answer would be 120. Yes or no, friends? Yes or no, friends? Absolutely yes. Moving on. Now they're telling us what is the marginal cost of sixth unit of output. Now if they're telling us marginal cost of sixth unit of output, how do we arrive here? Marginal cost of sixth unit is total cost at 6 units minus total cost at 5 units. So if it is at sixth unit, it is 690. When it is at 5 units, it is 610. When it is at 5 units, it is 610. So my dear friends, the answer that you are coming on to is 80. Is 80, 80, 80. And hence your answer will be 80. Right, sir? That's right, sir. Moving on, moving on, moving on. Where does diminishing marginal returns occur? Remember, diminishing marginal returns. You have to think from production perspective. I have given you the hint. Now you all tell me. I will not help you out. You will have to think. Come on. So my dear friends, you see here, production first increases. Remember, at an increasing rate and then increases at a diminishing rate. Yes, sir, we definitely remember this. Now you see what is it that they are telling. See, here the cost increased by 90, then the cost is increasing by how much? 80, then cost by 70, and then by 60. So cost is reducing, means production is increasing very fast. But again, see what happens. Surprise. From 540 to 610, it increases by 70. It increases by 70. So here it has increased by 70. So my dear friends, when it has increased by 70, so it means that now cost has started rising. Since cost has started rising, it means production has started increasing at a diminishing rate. And so when the cost has started rising up, see, initially it was falling, a downward trend. Diminishing returns occurs when the cost starts rising. And so 540 to 610 is occurring at 4 and 5 units. So that would be my answer. Is that crystal clear, friends? Yes or no, please? A very good and very important question. Most often people make mistake here. Absolutely, sir. We remember C. Got it. Now, what is marginal cost defined as? Okay, change in total cost due to 1 unit change in output. Seems all right. Total cost divided by output, no, that is average cost. Change in output due to, no. Total product divided by quantity of input, no. The change in total cost due to 1 unit change in output. That is the perfect definition. And hence 30 part A will be our answer. 30 part A will be our answer. Hence. Acha, sir. We have got the concepts. We have got the concepts. Now moving on. Which of the following is true of the relationship between MC and AC? MC and AC, which one of them is true? So see, my dear friends, between MC and AC. All right. Now here see, here it is average cost, here it is marginal cost. Now let me see what they are asking. Okay, let's see. If MC is greater than ATC, ATC falls. ATC curve intersect MC curve at minimum MC. MC curve intersects ATC at minimum ATC. Yes, I told you now that MC is like a motivational speaker. So it meets AC at its lowest point in life, and beyond that they rise further. Sir, we remember this. We remember this, sir. We remember this. Absolutely, sir. Very good, very good. Number one. Now, which of the following statement is true of relationship among average cost functions? ATC is AFC minus AVC? I don't think so. AVC is AFC plus ATC? No. AFC is ATC plus AVC? No. See, the relation is average total cost, or also called average cost. Average total cost slash average cost is equals to average fixed cost plus average variable cost. So obviously it follows that if you put average fixed cost at one portion and you send average variable cost to the other side, it will automatically become average fixed cost equals to average cost minus average variable cost. It automatically follows that way. And hence 32D would be our answer. And hence 32D would be our answer. Sir, we understood it. Absolutely fantastic. Now let's talk about the next one. Let's talk about the next one. Which of the following is not a determinant of the firm's cost function? Which of the following is not a determinant? Acha, they are telling not a. They are telling not a. Mind you, they are telling not a. Which of the following is not a determinant of firm's cost function? That is not useful in calculating the firm's cost. Let's see here. Production function, firm's cost function. Okay. Production, okay. Price of labor, taxes, okay. Price of firm's output, yes. Because you see, price of firm's output is like the selling price. So cost and selling price have nothing to do with one another. Because in order to calculate cost, you don't use selling price. To calculate cost, you calculate raw material. You calculate number of units produced. You consider the wages given to laborer. You consider the interest paid. To calculate cost, you don't use the selling price. And hence 33 part D would be our answer. Absolutely. Now moving on. Which of the following statement is correct concerning relation among firms' cost functions? This we have done, I believe, and we have done a similar question, so it's easy that way. Here the answer would be TFC equals to TC minus TVC. Again the same logic, because total cost is total fixed cost plus total variable cost. So if you take them one on the other side, it will obviously give you the equation. All right. Acha. Question 35, what they are asking, please answer. Suppose output increases in the short run. Okay, so more units are being produced in the short run is what they are trying to arrive at. Okay, more units are produced in the short run. So what will happen to the total cost? Will it increase due to increase in fixed cost only? Will it increase due to increase in variable cost only? Will it increase due to increase in both fixed and variable cost? Or will it decrease if the firm is in the region of diminishing returns? What do you think is your answer, friends? What do you think is your answer, friends? Come on, guys, need an answer. Need an answer. So see, output increase in the short run, total cost will increase due to increase in variable costs only. Remember, fixed cost will not change. Remember, fixed cost will not change. The short output increase in short run, total cost will increase due to increase in variable costs only. That's absolutely correct. Moving on. Which of the following statements concerning long run average cost curve, LAC is false? LAC is false. Come on, let's see it out. It represents the false. It represents the least cost combination. Yes, correct. It is derived from a series of short run. Correct. The short run curve at the minimum point of the long run curve represent the least cost plant size for all levels of output. And finally, as output increases, the amount of capital employed by a firm increases along the curve. So see, this one is false. The shortcut at minimum point doesn't reflect the shortest for all the curves. It's only for that particular curve. A minimum of one SSE curve is not the minimum of the entire LAC curve. It is the minimum of only that SSE curve itself. And therefore 36C would be our answer. The negatively sloped part of the LAC curve, long run average total cost curve, long run total cost curve. Acha, negatively sloped, that is the falling part. Yes, is due to which I have told you It is because of economies of scale. So it is basically increasing in production that results from specialization. So the answer is 37D. I told you when cost is falling, it is because of economies of scale. And when cost is rising, it is because of diseconomies of scale. Yes, sir, we remember this. We will remember this. Next, moving on. The positive slope, that is rising part of LAC curve, again is due to, yes, now it is diseconomies. Rising part of LAC curve implies rising costs. Rising part of LAC curve, friends, tell us about rising costs. Rising part of LAC curve, friends, tells us about rising costs, and hence your answer. Moving on. A firm's average total cost is rupees 300 at 5 units of output. Okay. Now pay attention, friends. A good one. 300 at 5 units and 320 at 6 units of output. Okay. The marginal cost of producing the 6th unit is what? The marginal cost of producing the 6th unit is what? Now, my dear friends, what happens is oftentimes students are in a hurry. Oftentimes they are in a hurry. Don't be in a hurry. It's given us average. So if average total cost at 5 units is 300, so total cost will be 300 into 5 at 5 units, which will be 1500. Acha. Again, total cost at 6th level will be how much? 320 into 6. That I believe gives you 1920. That gives you 1920. So if it is total cost is 1500, then 1920, then how much is it changing by? It is changing by, sir, 420. It's changing by how much? It's changing by 420. And therefore your answer will be 420. And therefore your answer will be 420. Acha, we got this, sir. So therefore we must remember that, my dear friends, that whenever you talk about total cost, you will always refer to average cost into quantity. You will always refer to average cost into quantity. We have done this in our previous class. Yes, sir, we definitely have. Now moving on. Number 40. Now we talk about number 40. A firm producing 7 units of output. A firm producing 7 units of output has an average total cost of 150 and has to pay 350 to its factors of production, whether it produces or not. How much of the average total cost is made up of variable cost? You have to tell me this. Now, my dear friends, see, average total cost of rupees 50. So what is total cost? 150 into 7. That's right, sir. So 7 zeros are 0, 7, 5. I think 105. Okay. Yes, sir, it's 105 only. Now, my dear friends, they are telling us and has to pay. Average total cost is A, producing at 7th unit. Okay, now what they are trying to tell us, that now they are telling us and has to pay 350 to its fixed factors of production, whether it produces or not. So now, my dear friend, if you look carefully, total fixed cost is 350. So if you subtract both, what will be total variable cost? Sir, 1050 minus 350, it seems our answer is giving us 700. Now total variable cost is 700 for 7 units. So for 1 unit, it will be how much? 700 by 7, because we are asked to calculate the average. So it will be 100. Average variable cost will be 100. A very good one. A very intelligent question. A very good question asked. Okay, sir, we got it, sir. Sir, we got it, sir. All right. Now, my dear friends, having said this, having understood this, let's talk about furthermore discussion. Let's talk about furthermore. Okay. See, a firm has a variable cost of 1000 at 5 units of output. A firm has a variable cost of rupees 1000 at 5 units of output. If fixed costs are 400, what will be the average total cost at 5 units? Simple. Total cost is 1400 and 5 units. So 1400 divided by 5, it gives us 280 rupees. So it's very simple that way. Nothing much to be discussed here. Yes. Yes. Now let's go about it further. A firm's average fixed cost is rupees 20 at 6 units of output. What will be it at 4 units of output? Now see, average fixed cost is total fixed cost by quantity. Now see, average fixed cost is 20. So 20 equals to total fixed cost by quantity, which is 6. Now total fixed cost is obviously 20 into 6. That gives you 120 rupees. Now you know total fixed cost is always same. The name is total fixed cost logically. The name itself tells you it is total fixed cost. So friends, if it is total fixed cost, I will tell you. Friends, if it is total fixed cost, I tell you 120. Now they're telling us to come at 4 units of output. Now friends, at 4 units of output, it will be 120 divided by 4, it will be 4. 120 by 4, you get it as 330, I believe, right? So therefore, your answer will be at 30. Is that crystal clear, friends? Yes, sir, it's crystal clear. Yes, sir, it's crystal clear. Now moving on. Which of the following statement is true? Which of the following statement is true? Question 43, as we have it. Okay. Okay. No, this is from production. So let's skip it one. Okay, because we have done that. My focus is now to do more on cost. Do more sums on cost. Okay, economies of scale. All right. Economies of scale exist because as a firm increases its size in the long run, labor and management can specialize in their activities more. Yes, we have discussed this. Skilled labor. As the large input buyer, firm can get finance at a lower cost. Yes. Financial economies and inputs at a lower cost. Yes, we have done that. If you remember, the firm can afford to employ more sophisticated technology. Yes, we have studied that in technical economies point, internal economy. So all these are causing economies of scale, and hence all of these are the absolutely correct reasons behind the economies of scale. So it's absolutely correct. Yes, sir. It's absolutely correct that way. It's absolutely correct that way. Now let's move on. Production function. What is it? Is the relationship between quantity of inputs and resulting quantity of product, tells us the maximum attainable output, expresses the technological relationship between inputs and outputs, or all the above. What say, friends? What do you think is the correct answer? See, yes, it is relationship between input and output. Actually, production function is relationship between output and all the factors affecting that output. So any factor, like it can be input, it is one of those factors. Again, combination of inputs. Again, technology is also an input. As far as output is concerned, you must use technology to generate output. So all of them are basically, referring to production function, because we had discussed production function is the relationship between output produced and the input applied for such production, or the input used for such production. Yes, definitely, sir. We do remember that. Let's see the next one. Which one of the following is a variable cost in the short run? Come on, a good one. Variable in the short run. Very good question. See, if we talk about short run, in short run, you must remember, guys, that labor becomes our variable factor, machine and land becomes our fixed factor. So wages paid to factory labor will be our variable cost. In long run, it is a fixed. In long run, it doesn't matter only, obviously, but yes, that is our answer. Okay, sir, we get it. Sir, we get it. The efficient scale of production, the efficient scale of production is the quantity of output that minimizes average fixed cost, average total cost, average variable cost, or marginal cost. Which one of them do you think is the correct answer? Absolutely. Efficient scale of production is the quantity that minimizes average total cost. Because at the end of the day, you are efficient when your total cost of production, hence average cost of production is at the lowest. Obviously, it goes without saying so. And hence your answer. And hence your answer. Now, if you talk further, in the short run, firms' product curve show that total product begins to decrease when average product begins to decrease, but continues to increase at a decreasing rate. A, B. When MP equals to AP, AP is decreasing but at its highest. When MP curve cuts AP curve from below, AP is equals to MP. Okay, remember. And then in stage 2, total product increases at diminishing rate and reaches maximum at the end of this stage. So they are asking which one of them in the short run is absolutely correct. So my dear friends, my answer would be D. Because you see, if I draw for you the diagram, the total product goes like this, this, and this. In stage 1 is where? Here, where total product is increasing at diminishing rate, and then it ends when TP becomes maximum. Remember, where does stage 1 end? Where does stage 1 end? Stage 1 ends where AP is becoming maximum. Where is stage 2 ending? Stage 2 ends when, yes, where TP becomes maximum. So accordingly, we will apply our logic. Right? Yes, sir. Yes, sir. Now let's talk about the other cases. Good question. Question 69. Come on, everyone. When marginal costs are below average total costs, when marginal costs are below average total cost, what do you observe? When marginal cost is below average total cost, what do you observe? Come on, friends. When marginal costs are below, you'll see, guys, I'll tell you this. This is the case, and there your marginal cost. Now, not to put the arrows, I'll tell you something. When marginal costs are below average total cost, as you can see here, in this portion, I'll highlight with blue. See, average cost is constantly falling. Yes. So average cost, average cost is falling, right? So average, when marginal costs are below, it is still falling. Because when average total costs are minimized, then marginal cost is becoming equal to average total cost. Understood? So don't be confused that way. Question 70. Let's see what we are able to answer here, or whether or not we are able to answer at all. Question number 7070 as we have it. A firm's long run average total cost curve is identical to its long run marginal cost curve. Also its long run supply curve, because it explains the relationship between price and quantity supplied. In fact, the average total cost of the optimal plant in the short run as it tries to produce the least cost. Okay, and finally, tangent to all curves of the short run average total cost. But here is our answer. Tangent means it touches them at one point. Now, you see, short run average cost 1, short run average cost 2, short run average cost 3. Now, if you touch their minimum points here, 1, 2, 3, it gives you like this. Boom. It gives you like this. Isn't it? Yes, sir. And hence your answer. And hence your answer. So it is tangent, is what we are basically dealing with. Now moving on. Let's see the next one. In the long run, if a very small factory were to expand its scale of operations, In the long run, if a very small factory were to expand its scale of operations, let me think. In the long run, a very small factory, okay, it is likely that it would initially experience increase in pollution level, economies or constant returns to scale. A really very easy question. Obviously, when you start operating on a large scale, initially what you will experience is what is called the economies, because this is referring to the advantages. So obviously what you will enjoy is nothing but the advantages, economies of scale. Yes, sir. Moving on. This one is repeated one. Now let's solve this 74 one. I'm giving you 2 minutes time, guys, so that you can solve it with yourself. A little on numerical side. Marginal cost of a firm for producing 9 units of output is 20. Okay. Average cost at the same level of output is 15. Which of the following must be true? AC and MC are both falling. MC and AC both rising. MC is rising, AC falling. It is impossible to tell whether rising or falling. What do you say, my dear friends, would be your answer? Come on. See, you have been told whenever marginal cost, we have discussed this last day in our relation, whenever marginal cost is greater than average cost, obviously MC is rising and AC will also rise whenever this happens. Acha. So an MC and AC are both rising. So the answer would be both are rising. Both are rising. You have to study relationship between AC and MC. We discussed last day. I had drawn this graph. You always remember this graph. This is average cost graph. This is marginal cost graph. And you see what is happening. Here, MC is lying above AC. Can you see it? Whenever MC is lying above AC, you see both are on the rise. Both are increasing. So you must remember this. Both must be rising. Okay, sir. Next question, a graph-based question indeed. Let's hear it out. What they are asking, what they are telling us. Let's listen them. Let's listen to what they are telling. Let's listen them. Okay. So they are telling us, my dear friends, in the following cases. Okay, pay attention. In the following cases, if you have a look, possible reason why the average variable cost curve approaches ATC as output rises is. Come on, see the options and tell me what you think is the possible answer. Come on, friends. See, AVC is approaching ATC because if you look carefully, let me highlight for you. See, initially the gap between them is too high. You see the gap, but as you move onwards, the gap is reducing little. You see here. You see the gap is further on the fall. Why is it so? My dear friends, the reason is this gap between average total cost and average variable cost is justified by something called, yes, average fixed cost. And you remember, with the rise in quantity, average fixed cost continuously falls. And this gap is representing what? Average fixed cost only. Since with the rise in quantity, average fixed cost is falling, and so the gap between them is also reducing, because this gap is representing nothing but average fixed cost. So AFC is falling. Absolutely. So average fixed costs are falling as output rises. Is the correct answer. Now see. Marginal cost changes due to change in what? Due to change in total cost, due to change in variable cost, due to change in average cost, or due to change in quantity of output. A good question indeed. What forces the marginal cost to change? Absolutely. Marginal cost changes due to change in variable cost. Yes, you are correct. Maximum of you will say that, sir, you told it will also be total cost. See, why is total cost changing? Because of variable cost now. And so the correct answer would be variable cost. Next, number 80, question 80. Which of the following statement is correct? Right, they're asking which of them is correct, not incorrect. They're telling which of them is correct. Fixed costs vary with change in output. No, it doesn't. If we have total variable cost and total, we get average cost. No, 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 wrong. Marginal cost is the result of total cost divided by number of units. No, that is average cost. Total cost is obtained by adding up fixed and total variable cost. Yes. Correct answer. Absolutely correct answer. How do you obtain total cost? By adding up total fixed cost and total variable cost. So that's correct, my dear friends. Which of the following statement is incorrect? LAC curve is also called the planning curve. ठीक ही है, correct है. Now which one? Next one. Total revenue equals to price into units sold. Yes. Okay. Let's move on to next 81 part C. Opportunity cost is also called alternative cost. Yes. Yes. If total revenue is divided by number of units, we get marginal revenue. No, we get average revenue. We don't get marginal revenue. We get what? We get average revenue. So the answer would be average revenue. How come you are writing marginal revenue? Yes. Finally, the vertical difference between TVC and TC. Yes, what does it mean? Let me draw for you the graph. See, the TVC curve is somewhat like this, and the TC curve is somewhat like this. So they have the same shape, but there is a constant difference between them. Why is it, my dear friends? Why do you think is that gap persisting? Will you answer this? Waiting for your answers. You people are absolutely correct. Same way that you applied the average logic, same way you apply here. Same way apply here. And so, sir, you are telling us the answer would be total fixed cost. Because indeed, the difference, the gap between the two is represented by total fixed cost only. Is represented by total fixed cost only. So there is no harm in telling that the correct answer here would be total fixed cost. What would the correct answer be, sir? The correct answer, my dear friends, would be here in this given scenario, total fixed cost. So our answer is total fixed cost. I hope you will remember this. Okay. So here it is. Our answer is total fixed cost. Right, sir? Now let's move on to some other questions. They might relate to cost or anything we will discuss. Now see here. What is it telling? Now let's have a discussion here. Let's have a discussion here. Economic cost of production differ. Very good question. Economic cost of production differ from accounting production. Why? Because, come on, see this and answer me. A really good one. Question 77. What do you think is the probable reason, friends? So see, I will help you out here. See, Economic cost of production differs from accounting production. That's right. That's absolutely right. Let's see the options. Because economic costs include expenditure for hired resources, while accounting costs do not. Let's see. Accounting cost includes opportunity costs which are deducted later to find paid out costs. Accounting costs include expenditure for hired resources, while economic costs do not. Economic costs add the opportunity of a firm which uses its own resources. Absolutely. So 77D. Because see what happens. In accounting cost, you will only subtract those costs which result in actual outflow. But in economic cost, yes, you will deduct the accounting costs, but also if in the process some income has been sacrificed, that is also computed here. Yes, that's why my dear friends, the answer is economic cost at the opportunity cost of a firm which uses its own resources. Economic cost at the opportunity cost of a firm which uses its own resources. That, my dear friends, is an absolutely correct answer. So this is our answer of 77D. I hope it's crystal clear, everybody. Yes. Now let's see the next one. Implicit cost can be defined as money payments made to non-owners of firm for self-owned factors employed in the business and therefore not entered in the books of accounts. Money not paid out to the owners of the firm. Yes, you must be owner for self-owned factors and therefore not entered in books of accounts. Correct. That is implicit cost. You must be the owner and it must not result in actual outflow. You are just sacrificing an income. Why? Because instead of keep putting that out on rent, you are using it for your own business purposes. Remember, for implicit cost to incur, everybody write down in the chat. After that only I will move forward. Everybody write down in the chat. For implicit cost to occur, ownership of resources must be there. For implicit cost to occur, there must be ownership of resources. For implicit cost to occur, there must be ownership of resources. For implicit cost to occur, there must be ownership of resources. Because if you're not the resource owner, remember this. Remember this. Sir, understood. So this one is an easy thing. Right, sir? We got it. Now moving on. Let's move on to the next one. See, now pay attention, guys. This one, a slide from production, but a good one. Good question from production. Please answer me this. After the inflection point of the production function, a greater use of variable input induces a reduction in the marginal product. Before reaching the inevitable point of decreasing marginal returns, the quantity of output obtained can increase at an increasing rate. Acha. Correct. The first stage corresponds to a range in which AP is increasing as a result of utilizing increasing quantity of variable inputs. It's from production, right? And I told you, if you study production, you've got to study costs. Both are quite interrelated to each other and all of the above. Which one do you think is the correct answer, mates? Come on. Question 62. Right. So 62 will be D. All of them are true. Yes, at the inflection point, MP starts falling because MP has already achieved its maximum at the inflection point. And yes, before reaching decreasing returns, we first enjoy increasing returns. So all these are correct, not at all wrong. Okay. So now, let's move on to the next one. Basically, this question, what do you see here? Number of workers 0, 1, 2, 3. Output is like this. Is it constant marginal product of labor? Diminishing marginal product of labor, Increasing returns to scale or increasing marginal product of labor? Whatever you see, come on, answer that. Come on. 56. Think and answer, huh? Don't be in a hurry. Come on. See. Now the thing is very simple. Now the thing is very simple. 0 to 4. Now you see, it is changing by 23. Okay. Now here you see, it is increasing by how much? It is increasing by 17. Here it is increasing by 10. So as you can clearly see, my dear friends, a decreasing returns is operating at this level. And so your answer is, diminishing returns. So diminishing marginal product of labor. I hope all of you agree with me on this. Yes. This isoquant question we had skipped. Let's discuss it right now. Okay, this isoquant question that we skipped, let's discuss it right now. Okay. As an isoquant shows all various combinations, remember, it shows all various combinations of two inputs that can be produced by using a given set of output. Array, how will you use output to produce inputs? You use input to produce output. So obviously it is wrong. All the alternative combination of two products among which a producer is indifferent because they yield the same profit. Remember, we are talking about isoquant. We are talking about isoquant. So it doesn't mean that they yield the same profit. It's because they give the same output level. So this is wrong. All the alternative combination of two inputs, yes, that yield the same total output level. And so your option will in reality be C. And I have also told you, remember that isoquant is much like as we had studied indifference curve. Yes, it's much like indifference curve as we had studied. That's right. Now see the next one. Question 46, please pay attention, friends. Question 46, please pay attention. All right. If decreasing returns to scale are present, then if all inputs are increased by 10%, then output will also decrease by 10%. Remember, you're talking about returns to scale, meaning long run. Output will decrease by 10%. Output will increase by 10%. Output will increase by less than 10%, or output will increase by more than 10%. What say, guys? If it is decreasing returns to scale. Returns to scale, come on. Returns to scale, please, come on. So see, the answer will be yes. If you are increasing inputs, output will increase, but at a slightly lesser than 10%. So output will increase, but at slightly lesser than 10%. So the answer will be output will increase by lesser than 10%. Here it is. Here it is. Okay, sir, we got it. We got it, sir. Now let's move on to the next question and see what is going on here. All right, let's move on to the next one. I'm sure everybody is agreeing to these things, right? Now, a good question. The law of diminishing return applies where? Question number 12 I am discussing. Question number 12 I am discussing. Come on, let's answer this one. The law of returns, diminishing returns as they call it, applies where? Option A, in the short run. Next question is in the long run, not in the short run. Short run, not the long run, not the short run. Both short and long, neither short nor long. Obviously, the law of diminishing returns will operate in the short run, but not the long run. In long run, you have law of decreasing returns to scale. It's nothing called diminishing returns. Okay, that is just a short run phenomenon under law of variable proportion. Remember. Acha, my question is, what is law of variable proportion also called? What is law of variable proportion also called? Hint is returns to a dash, a single word you will have to put. Law of variable proportion is also called returns to a dash. You will have to fill in this blank. Law of variable proportion is also called returns to a dash. Answer me this question. Absolutely. You all are absolutely correct. Returns to a factor. Achha. Another question from cost, numerical question from cost I'll give you. So please, pay attention. My thing is very simple. I'm telling you a one simple thing. Pay attention. Okay. Now marginal cost of unit 1 is 10 rupees. Marginal cost of unit 2 is 15 rupees. Okay. Marginal cost of unit 3 is, let's say, 16 rupees. Just say. Okay, just say. And total fixed cost is rupees 100. Okay. My question to you is, what is total cost equal to? Come on, answer me this. Obviously, what is total cost equal to? Obviously, total cost for 3 units, because 3 units have been produced so far. Total cost for 3 units equal to. Come on. Answer this, friends. Answer this. You people are absolutely correct. See, whenever you add marginal costs, so let's say you have 10 here, then 15. So that gives you 25, and then you add 16. That gives you 41. Okay. And now total fixed cost is 100. So 100 plus 41 is how much? 100 plus 41 is giving you 141. 100 plus 41 gives you 141. MC3 was 16, right? So when you add all the 3 MCs, that is 10, 15, and 16, as you see here, you get 41, and TFC was 100. So 141 is your answer. Okay. Next one. This question, number 8. Question number 8, please, everyone. Question 8, please, everyone. So, my dear friends, if you see here, the short run and economist uses as economists use the phrase is characterized by at least one fixed factor of production and firms neither leaving nor entering the industry, generally a period shorter than 1 year. Okay, what else do we have here? What else options do we have here? All factors of production are fixed and no variable. Absolutely incorrect. No time period. Okay, all inputs are variable. Wrong. So the answer is at least one fixed factor and other can be variable. At least one fixed factor and other can be variable. That's the correct answer, right? Yes, sir. Moving on. Question number 5. Yes, sir. Please tell us. We will answer this. Now, question number 5 is, in the production of wheat, all the following are variable factors that are used by the farmers. So all the following are variable factors except, so farmer is using all of them, but which one of them is not a variable factor? Seed and fertilizer, we have discussed this. Field, tractor, or number of hours. Let's see whether you remember, because we did it last day. This question individually. Come on, tell me. Absolutely correct. Your answer will be the field. Land is considered a fixed factor. So your answer is correct. Next question. Which of the following statement is true? Question number 4 we discuss here. Okay. Accumulation of capital depends solely on income of individuals. Which of the following is true? Solely? No, not only income of individuals, companies, etc. Savings can be influenced by government policies. Yes, it is absolutely correct answer. You know why? Because see, my income is, let's say, rupees 100. Okay. Now, if government imposes tax of rupees 30, then my savings, suppose my expenditure is nothing, for example, then my disposable income is reduced to 70. If government makes this 30 to 20, my savings will go up to 80. So yes, government policies influence the kind of savings we possess. And hence our answer will be, yes, savings can be influenced by government policies. Yes, our answer would be savings can be influenced by government policies. So my dear friends, you will be happy to know chapter 3, theory of cost and production is completely over with all the MCQs completed. Please read them out. Please revise them. Next day we start with our discussion on markets. See you all in the next class. Goodbye. Thank you very much. Bye bye. Tata.